schematic in terms of understanding how runs on liquidity and then a repricing lower occurs. So what we need to know is, where is liquidity? Now there's two ways to use the breaker. This is a bearish breaker, and what we're understanding with this diagram is there's obviously when you have a market that is predisposed to go lower, if you're anticipating the market going lower, if you're looking for a bear market to provide an additional entry or a point of reference for pyramiding new short positions, this is what you're looking for. Okay, this is one of the strongest PD arrays I have, because the characteristic behind this PD array is acting on pending orders. So if you've ever traded and had your stop run hit and then see it run in your favor after your stop loss was hit, that's what this pattern capitalizes on. It really takes you into the marketplace in terms of a narrative to attack the ill-informed or retail trader that tries to look for continuations. If they have no idea where liquidity is and what the narrative is and why the market should be going lower, they get many times trapped by this move. They will be caught being a buyer of a breakout above a short-term high, and then it only goes up to a higher time frame buy-side liquidity where the actual reversal occurs. There's two stages of liquidity for the highest form of precision with my breaker. You'll always have the short-term buy-side liquidity above the short-term high, but it's going to want to reach into a higher time frame buy-side liquidity, and then you're waiting to see if it runs away from that. And then inside of this price leg from A to B, that right there is what you're looking for targeting. So this A to B leg, we're ignoring all this. This is market protraction. Okay, this is the manipulation. So with this out of the equation, okay, think of this as time distortion. It's running from the low to the high to get that liquidity. But once it does that, ignore it for a second, because this is not the 2022 model. 2022 is something entirely different where you would use this price leg. Oh, you're confusing me, ICT. I understand. If you watch the videos, there's two different approaches being used. Okay, we're using the price leg from A to B. Once this market creates this run here and starts to drop down, if I trust that I'm on side, that means I'm bearish. Okay, I'm expecting lower prices. I'm already going short when it runs above the buy side. It may not be my biggest position. I might scale in a larger portion. I'll give you an example. The model I've been showing you with trading ES is I'll go in and trade 6 contracts first, and then I'll add 3, and then I'll add 1 for a 10 lot position. So I'm scaling in. This type of trade here, I would go in with 1, add 3 in here, and then 6 on a really good run into the breaker. I'm building in the likelihood of, even if I'm wrong and it goes against me on the 6 contracts, I have 3 and 1 that help offset or mitigate most of the drawdown that would be occurring if it was to quickly reverse and take out that high. I'm not suggesting that you should trade that way, but I am trying to teach you a little bit more in terms of an amplification of the breaker pattern. This A to B price leg, you take that leg from the high down to the low and you lay your Fibonacci on that, and then you do your standard deviations lower. Whatever this range is from here to here, 1 standard deviation lower, that is the easiest bread and butter approach to using the breaker. If you're on side and you know what you're looking for and you're in a bear market, you don't need it to come down into this level here and trade back up. Many times you'll see me annotate a breaker and I'm entering in this price leg running lower before it even breaks out that low. I could be selling short throughout this entire range using the 2022 model and then use the breaker as an additional area where I can add and pyramid more. Or I can simply just wait for it to come back down, wait for it to provide some means to go back up here. Now here's what you're afraid of. What happens if I go short here and it goes right up here or goes into my stop loss and stops me out? You take a loss. How's that for logic? Then you consider, does it still want to go lower? If it does, and nothing's changed, you just got stopped out, you just go in again with half the position size that you used on your first trade. That's all you do, folks. Obviously, like everything I teach, everything can be reversed. And what we want to see here, if we're bullish, this could be a reversal pattern, or it could be a continuation in an existing bull market. Okay, so if we're presently under a buy program and we're expecting higher prices, this can be used intraday. Any time frame, by the way, these patterns form. But you have to understand where there's liquidity. And the best breakers are going to see 2 levels of sell side. Obviously, the short term that would be created with the short term level here and a rally up, and then a lower drop into a much more significant or higher time frame sell side liquidity. So there's 2 pools of liquidity that's being engaged here. It's this one by default that makes the breaker, and then we're seeing it reach into another level. The qualifier that I like to see is I already anticipate this liquidity here, a lower drawn liquidity. And I love when it goes down real close to it and starts to rally, because I know what that's doing. It's enticing folks to see that that's a time to go long. And this run higher engineers more liquidity below that low and makes this a much more juicier liquidity pool. So it drops aggressively down in here. Once it takes this sell side out, I could be going long if I'm extremely bullish. If I'm on side, I'm trusting all my analysis, everything is indicating that this market, whatever it is going to go higher. I will buy those sell stops. Now, you may not have the confidence to do that. That's okay. You can treat this price run here. You can use the model 2022 to enter in that. Any fair value gap in here that forms, you can anticipate that run. Or use the rules that takes out this high here. Any retracement back then later into that price run, that would be your 2022 real rules. But I can be entering in this without any need to take out that high yet. But once it gets down here, my eye goes right to that leg from A to B. And I run standard deviations off of that. And the easiest bread and butter setup would be is using the low to the high, being long in here or somewhere in here with a fair value gap for institutional order flow entry drill, or inversion fair value gap, something in this leg here, there would be a fair value gap, retreat it back above it, find some support, target here, and then 2 legs of this run. So in other words, whatever this low is to this high, add it to this high, up. So that would be 1 standard deviation of this price range, A to B. That is the easiest bread and butter setup. You can literally carve out an income career just with that. Little ICT is going to teach you how to take this information and supercharge it. If you understand where the market's going to go on a higher time frame, if you're utilizing something like this pattern here to get in sync with a higher time frame buy model, you can then use the standard deviations between point A and point B and see if they agree with a larger, higher time frame pool of liquidity that you may be utilizing for the ultimate bias or draw that you're reaching for based on the higher time frame trade. So I'll give you examples of that. So here we have the low, the high, and this is a 5-minute chart, by the way. Low, high, lower low. So this is a breaker. Inside of this price leg from A to B, remember we're bullish, we're looking for the run from this low to high to do our standard deviations. I've already went through the idea of buying it here because we can be buying inside this leg right there. We don't need to see this high broken and trade it back to this support. That is one way of using a break. But when you understand where the market's likely to go, you can trade in this run before it happens. But this low to high to lower low, if you take that A to B leg, you're ignoring this as a run on liquidity. So all of this is time distortion. This drop down is both manipulation and time distortion. You are getting knocked out if you're long and using this as a stop loss. The market comes back down, reprices to that level, does the dirty work of knocking those traders that have a sell stop below here on their long that were maybe briefly profitable, and then drops down and goes against them, stops them out. If you did take a trade like that and you get stopped out, you wait for this type of scenario here where it creates an imbalance. Once it does that, you can be a buyer right there. And trust that we've already did a stop run with this run here below that low. But A to B price leg, you use that for your standard deviations. From here to here, you start running scenarios where you have a standard deviation of -1. So that's 1 standard deviation. This leg from here to here, projected higher, so it's a measured move. You're not measuring from here to here, you're measuring here to here. Inside this price leg, we're using the up close candles. This down close candle right there, that disrupts this price run. So it's this range right there. We would use all that range there for a return back into the breaker. If I think that we're going to go higher and need to pull back into a larger retracement, we wouldn't want to expect that to here because it's number one, it's Friday of last week. It's really close to that June 16th high anyway. So we don't want to see a deep retracement. So what makes me comfortable buying inside of the price leg before a breaker is ever qualified? Because I understand that I'm on side. Everything is indicating that it wants to run to a pool of liquidity or inefficiency above the marketplace. And I'm including the idea that we're on Friday. So the market's going to be in a hurry to get to that liquidity and draw maybe up into that weekly volume imbalance. So we have 2 real strong factors acting like a magnet, a draw on liquidity, pulling price up. So all this insight here allows you to differentiate how we use my breaker. You have to understand the narrative, the day of the week, all the factors involved, and blending a lot of other things. If we take this information and go one step further, we have relative equal highs right in here. So when it goes above it here, did it take out the buy side at that 44.96.5 that was measured with this range here yet? No. But we can now use this as a qualifier for a new breaker. So it could be reaching up there to go lower. And if it was to do that, we can anticipate how far it's going to retrace lower with the Friday retracement. We can use this information with the breaker for targeting. We can frame if there is going to be like a TGIF trade where you anticipate the market trading back into the weekly range, which is what we're seeing here. It needs to get to this liquidity before it does that TGIF trade. If you look at the high here, which doesn't break above that 44.96.5, it trades to it. It's exactly at 44.96.5. Remember, that's this A to B. It goes right to that level there, but doesn't go any higher. And it drops down and it creates what? A breaker. But how can you use this information if you want to be a TGI trader and trade inside the range or the weekly range as a pullback? Look at this breaker here. A, B, and this run higher. This here is just part of this run. So this is inside the range that would take you above. Because look at the bodies. See where they're stopping? These little mohawks. That's what a mohawk is. The bodies are saying that, okay, we're not done. It's going to reach higher. Why? Because this standard deviation of 44.96.5 was just simply confirmed one more time with the bodies. That means it's going to go higher. So we would still use this high to that low. Watch what happens. A to B. Why not this one? This one's the same one as this. Look at that low. It's the same low I'm showing you here. But what I'm doing is I'm ignoring this high here because it's unfinished. It's going to run higher. It's either going to go to the weekly volume imbalance or run out that high. I don't need to know what that is yet because the A to B leg is already there. This one didn't go lower, but now watch what happens. 2 standard deviations inside this inefficiency, inside of the breaker. Okay, we're looking at a 1-minute chart. Okay, so now we can see how we're utilizing the upper portion of the breaker here. You zero in on the change in the state of delivery, that last candle right there. Inside that last candle, I can be a buyer anywhere in here. I can use that order block. See this down close candle right there? It's inside of this breaker. It's the last up close candle when we're in the lowest time frame. So you want to strip it down into the range. Remember, we showed this entire run here on the 5-minute chart. But for fine tuning your entry, it's the last up close candle prior to the lower run to there. When it's trading in that range, if I have something else inside of this little pocket of price action, if we look at the high and the low, if we measure that range, okay, and there's gradients to that. Upper quarter, 50% or mean threshold, because it's an order block theory. Breakers are order blocks. And then the low and the lower quarter. Midpoint or mean threshold is 4484.50. Now, if the algorithm is going to allow price to be utilized there to go long, what price does this market need to price to get 4484.50? It needs to at least print 4484.25. Inside of this consolidation, it rallies above it and drops back down. What's the low of that candle right there? 4484.25. That allows the spread to not be a hindrance for smart money to go long there. Even if you don't take that as a trade, does the market show a willingness to move away from that? Yes, that's a signature. I'm watching that. I'm seeing price do that. I want to see these types of things come into the marketplace to support the idea that we're going to continuously grind towards that buy side liquidity and maybe reach up into that weekly volume imbalance. Once we're inside order flow, we have inefficiencies. We've seen the long here, and then we're seeing an inefficiency here, but we're bullish. So we're not looking at this as the trade up into here and then sell off. Look closely. You see this low, high, lower low. Remember, I'm long in here. I'm buying all that. What am I utilizing? Look at those levels. Look at them. What am I buying? Consequent encroachment of that 5-minute fair value gap. It's defined by this level and that level. Then I'm buying what? Consequent encroachment of the inversion fair value gap, which is this level here. I expect this to be support and find a point of accumulation to send it higher, to attack buy sell liquidity and draw up into the high on the 16th of June. 2023. So I'm using these reference points like rungs on a ladder, okay? Or think of it like a mountain climber, okay? Where they're going to reach and grab and hold onto that rock face and pull themselves up higher. Well, I'm looking for all these areas as price presents them. So when price was down here, that fair value gap was already there. So I'm accumulating long positions here, right in the middle of it, which is consequent encroachment of the 5-minute fair value gap, which is these two blue lines. That gap was already there on the 1-minute chart. I want to see it trade up there. Look at the body, respecting it. See it? It's staying inside of that gap. Then it comes back down. I'm buying it when it's in the midpoint of it right there. I'm buying it there. And then I'm buying the low end range of it there. So I'm accumulating and pyramiding with logic. But now because we can see this low, high, lower low, that's a breaker. I'm utilizing all that framework. I'm going inside this price leg with the support of this idea as a breaker. Because this is an A to B, and this is all distortion and manipulation, I'm using that as the entry point. But I'm going back into this little short-term price leg right here. Low, the high, okay? Now watch. All of this is occurring, by the way, in the 1150 to 1210 macro. Okay, it's a specific sweep period of time where the algorithm will start spooling, reaching for liquidity. But this leg here, that's the A to B on that breaker. If we take that and we know that that buy side liquidity is on June 16th, 2023 high, the daily candle, it's drawing up into that, and maybe even as much as the weekly volume imbalance.